Hi Arjun. So
Hi.
this topic is very important for our clients, and also I've been also thinking about it. Although we would have actually done this session in our office, but due to COVID we have to do it on a Zoom. Nevertheless, since this is an important topic, I thought we will discuss it first.
Absolutely.
So basically, what they are asking is, what is rebalancing and why do we need to rebalance our investment portfolio?
Yeah, it is a great question. And I think it is one of the cornerstones of our strategy, right? So rebalancing in a very simplistic terms is you have an investment portfolio. Any point of time, you make changes to that portfolio by selling a particular asset class and replacing it with another asset class. That is called rebalancing, right? That in layman terms is what is done. Sounds very simple, but a lot of work goes into it.
Mhm.
And also it is one of the most important components of one of the other topics that we touch upon, which is asset allocation, and which is the core strategy of generating returns and reducing risk for our investors.
Right. Okay. So there must be different strategies for rebalancing. How is it like? How is the rebalancing actually done?
Yeah, so there are a lot of strategies that different firms and different investors follow. I I will share some of them with you, and then I'll come to what we do as well. So there is the first and the most a common type of rebalancing would be your calendar rebalancing. So it is specific to a time, right? So you would
Right.
rebalance your portfolio once every year. It could be the new year, probably January, or it could be a new fiscal year. So in April, it could also be twice in a year, right? So that would be your calendar-based rebalancing. That's one type of rebalancing. The other type of rebalancing, and which is core, I think, which most of the institutional investors do, is strategic rebalancing, right? So strategic rebalancing sounds very fancy, but basically what it is depending upon your policies, right? So for example, uh, you the policy of your investment strategy is that uh, your portfolio, your investment portfolio of the client should have 60% equity and 40% debt, uh, and for majority
As a
of the
part
time,
of the portfolio.
as a part of the portfolio for majority of the time during the investment horizon, for example, right? But suppose you have a bull run, right, which is typically seen in the recent past only, and the equity portfolio of your becomes 70%, and the debt becomes 30%, right?
Mhm.
So because the policy says 60%, you rebalance to make that equity back to 60, purchase some more debt, right? To make it like a 60-40 again. The moment it falls from like, or it goes up from 60 to 63, you try to bring it down. But then there are opportunity costs because there's a transaction cost, and
Mhm.
there's taxation and so on and so forth. So typically people don't do it. So they generally have a percentage buffer, right? So if it goes up 10%, then we rebalance, right? So we will not rebalance if it goes from 60 to 67, for example, right? We will
So basically,
rebalance,
what you're saying is, whenever there is a change in the markets,
right?
valuations,
Mhm.
then the portfolio has to be looked upon whether it is uh, still, as per the plan that we set out for that specific portfolio, and whether there any change is needed in the debt or equity exposure.
Right. So as per the policy. And
Right.
the third kind is which which a lot of people spend a lot of time on, and where actually the benefit is not that much, but sometimes it is necessary, which is tactical rebalancing. So tactical rebalancing would be calls like, okay, in my portfolio, my equity portion uh, has these many sectors, and this sector is overvalued. So I should rotate out of it and move into some other sector by reducing. If I only have a stock portfolio, for example, right? That could be a tactical. The other would be relative assets between in the portfolio. For example, debt equity, right, are the two most common asset classes in any asset portfolio. There could be real estate, gold also, but conventional assets would have equity and debt, right, or fixed income. And then you say that, okay, equity looks expensive, right? But we are in a policy range only. The policy range has not been breached, but the debt is looking more expensive than equity, which is counterintuitive to think about. But every market asset class is either overvalued, undervalued, or fairly valued, right? Whether it's debt, because it's traded in the markets, right? So if you remember, in August of 2021, we did tactical asset rebalancing for our clients, which was very timely, because after that the markets really ran up. But our call was that even though the equity was fairly valued, actually it was on the border of being overvalued, but the debt was definitely overvalued. So you would rebalance that portion at that point of time, right? So all these three are your, you would find in 95% of the investors follow this. Now, if you ask me, we do something, I don't know what name should I call it, but we do something which I fundamentally believe in, because all these are rules of thumbs, right? Because you cannot forecast what the market is going to do. So our approach, and I fundamentally believe in this approach, is that the market doesn't care about your investment or how much you have invested, right? Or how far your goal is. It does its own thing, and nobody can time the market, right? But what you can do is, you know where you are in the market cycle. If you are an expert, you should know that, based on macros, based on the valuations, based on the long-term economic growth of the markets in which you are investing, right? So there are a lot of background research that you have to do, but ideally, you should be doing that. And that's what we do for our clients also, that where are you in the market cycle? I don't know when the market will correct, if I think it's overvalued, but I know it's overvalued. So I have to make a conservative portfolio, right? So if my policy says, no, for an overvalued market, the equity should be 30 and debt is 70. I'm just giving an example. It's not like that actually. So if 30 and 70, the equity should be 30 and debt is 70. But based on the nuances, based on the economic growth, macros and all, we can decide it should be 35, for example, or 34 also, and 46. Just because it's a multiple of 5, we won't do that. You're getting right? Because whenever you do it, it becomes ad hoc or based on heuristics, where you tend to go wrong. You should know where the market condition is, what the market condition is now. And based on that, then you start doing that rebalancing. I know I went a little detail into this, answering this question.
But it is definitely helpful. Okay. And I think I would also like to know what factors need to be kept in mind before rebalancing.
So some of the factors I've already mentioned in this previous question, right? The key components, but you also have to look at some other additional things. So, like for example, tax implications. That is a big one, right? So, for example, when we did tactical asset rebalancing in August, where we thought that debt is overvalued, and a call was right, and we reduced the debt component and increased the equity component for our client portfolios, right? In that case, we also have to measure what is the tax implication, right? So the benefit of the rebalancing should be higher than the tax outgo, because there's a transaction, right? You redeem some fund.
It would not make sense.
They would have to pay tax. Then also, in some cases, for example, in mutual funds and all, you have exit loans, right? So you may have purchased the fund, and the holding period may be less than 1 year. Right. You also have to take into consideration what is the tax rate of the client, right? So, for example, I'm selling debt, and it's a short-term and a short-term capital gain tax would be applicable. The maths changes if you are in the 10% income tax bracket versus the 30% income tax bracket. Right. Majority of our clients are in the 30% tax bracket, but sometimes it happens the spouses or other family members are not in that tax bracket, right? So you have to take all these nuances into consideration. So it's a very elaborate process. It's not something very by the rule of the thumb that you just stick to it and do. It's a very important process, like I mentioned, right? Got it. But one thing I want to clarify, whatever I've said till now is for lump sum investments only, not your monthly investments. There also you do rebalancing, but that's a different kind. We can get into it some other time. What I've told you is about lump sum.
Right.
Right.
But nevertheless, it was a insightful discussion, although short, but we got into quite a lot of details. So thank you for elaborating and for throwing the light on this topic.
Yeah, no problem. And if anybody has questions, they can always send those questions into investments@everguardlife.com, and we will be happy to answer them as well.
Yeah.
All right, Anu.
Sure, yeah.
Have a good day.
Yeah.
Thanks.
You too, Arjun. Thank